And I find it interesting that the Federal Reserve is lending money to the FDIC. And if you realize, if you take away the commercial banks and say there's roughly $9 trillion in deposits in the regional banks, how is it that 128 billion or even 173 billion, if you take the loan that they were given by the Fed? And so this FDIC illusion of safety is something that I think people will realize is nothing more than the Federal Reserve standing behind them with the printing press, waiting to destroy the value of the dollar even further if we see more and more of these regional banks fail, which I expect they will. At the end of 2022, there was a report that just came out by the Federal Reserve who said that 722 banks were technically insolvent at the end of 2022. And that means that they had at least 50% of their capital was underwater. And these are called unrealized losses, whereby, of course, the rising interest rates have created significant strain on this. But if they were to get a run on the deposits where the depositors request redemption, the only thing that they would have been able to do at this point, or any of these 722 banks would be able to do, would be to sell those assets that are underwater. And that's why we saw in 36 hours it put Silicon Valley Bank, just like that, out of business. So there's a lot of these banks that are underwater. Technically, central banks buying record gold for the last 18 months more than any time in history. Why? What do they see coming? They're front running as well. It's the people who have the most money are also closest to the information. So it's like a football game. In the huddle, you know where the play is. So you can front run the route. The defense has to react. They are front running an outcome that they know is inevitable. And I think that's really the scariest thing of all, is that if you realize that these insiders were selling or that the central banks are buying gold, the question is why? Why are they doing something early when it doesn't really make sense to the masses? Because they know the information and they're able to get in front of what's coming before it becomes obvious to everybody else. What a lot of these people are doing, you ask what can be done if not to buy metals. It's what everyone else has been doing, pulling their money out of the uncertainty of the regional banks and moving it to the handful of the commercial banks and into the safety and, if you will, the daily liquidity of the money market accounts that are paying 5% when you can't get that even in a CD. The highest rate CD you get might come close to that, but you're locked in for a year in a regional bank that we are told will not be bailed out if they fail. So you have the risk of the bank. You have not getting the same return you can get in a commercial bank, and you have not the daily liquidity because you put it in a CD, you're locked in for 6 months or a year to get those rates, whereas the money market accounts right now are offering daily liquidity in a bank that's too big to fail. It's scary because these are the banks that have massive derivative positions. JP Morgan has over 50 trillion in derivatives. These are the banks everyone ran away from into the regional banks because the perception was that they were much safer, and we always thought they were until we find out they're not. Short of buying gold and silver, Robert, and tangibles, assets, if you look at the wealthy own assets. It's not massive bank accounts as much as it is assets that feed you and liabilities that eat you. I guess what can people do? They can get out of variable rate debt first and foremost. As rates rise, that variable rate debt increases. You can buy silver as often as you can, even if it's just a few ounces at a time. And if most people don't see what's coming, they can't get out of the way of it. If you're listening to this, if you have the ability to own some precious metals, do so, because as Robert said, it is an asset that is not simultaneously someone else's liability. The concept of counterparty risk is something that's going to become more and more and more entrenched in people's psyche as we see more and more banks fail, and what it means to be involved in an asset or in an instrument that contains counterparty risk. Because if a counterparty fails, what does that mean to you and the asset that you hold that is valued upon the counterparty's ability to perform? Not so good. So removal of counterparty risk, removal of variable rate debt, removal from the system, best you can, is where you start. And depending upon your means, well, then you have different ways of achieving that. But I think removal of counterparty risk being the primary objective in all of this, because you know what? It's one thing for me to say the stock market's overvalued, or the real estate market's overvalued, or the bond market is overvalued and risky, and they all are. It's another thing to say that the money that you're holding for your business, for your family, in your 529 plan for your kids' education, that it's all in a very precarious position inside what amounts to almost 5,000 banks that have been the backbone of the U.S. economy for a very long time. You know, the amount of credit that is needed to bring a loaf of bread to market is extraordinary. If you think about it, the farmer who's using the regional bank has a loan or a line of credit to buy the combine, to buy the diesel fuel, to buy the seeds, to plant the field. When he harvests the wheat, he gives it to a trucking company who has loans from regional banks for the trucks and the diesel fuel, who then trucks it to the flour mill, who has loans with the regional bank on operations and employees and all of these things. And then that goes back to the trucking company once it's refined, who has loans. And then that goes to the groceries or to the baker, who has loans to run his bakery. And money held at the regional banks to run the bakery. And then that goes to the grocery store by truck again. I'd like to just make one other point about the debt ceiling. You know, last time they raised the debt ceiling, it was Janet Yellen said, we have to take extraordinary measures to do so. And it was very hard to find what those extraordinary measures were. I found it in a Yahoo Finance article after doing a tremendous amount of digging. She had to borrow money from the Civil Servants Retirement Fund, the Disabled Veterans Retirement Fund, and the Postal Workers Retirement Fund just to raise the debt ceiling so that we could vote to give more money to the Ukraine, including money to their government pensions, when there's a $1.75 trillion pension shortfall here in this country. And the decisions that are being made by our leaders are just absolutely insane. As we've talked about before, this growing cohesion around the world of countries joining together against the Western hegemony. If they dump dollars, if OPEC and Saudi Arabia, which if you look at the things that are happening, Saudi Arabia, all of the things that they've done, including just joining the Shanghai Cooperation Organization, meaning they're now being protected by China as well, not just Russia. And if you look, they've joined the BRICS, they've joined the Belt Road. They told the folks at Davos they're open to taking other currencies. And as we've talked about in podcasts 2, 3, and 4, what makes the dollar the world reserve amongst many other things, the biggest thing is the fact that Saudi Arabia and OPEC price oil in dollars.